The week following the UK's decision to quit the European Union has of course been busy with a heavy political agenda, with unscheduled meetings among the business leaders and policymakers. Now, UK Prime Minister David Cameron gathered an exclusive lobby of business leaders to discuss how to approach the European Union partners for renegotiations of trade terms and how to get the best deals with the EU and abroad. Investors are now expecting new fiscal measures, corporate tax cuts, for example, to be quickly implemented in order to counter a potential economic slowdown or even a recession, which many are scared of following the Brexit vote. The Bank of England Governor Mark Carney has also decided to step in this week. In his speech in London on Thursday, Carney hinted at a lower bank rate, as the economic picture in the UK has, according to him, deteriorated after the Brexit vote. Carney said that some monetary policy easing will be likely required over the summer. The activity on the Gilts market suggests that the market gives a decent 85% chance for an interest rate cut to happen by November this year. Sterling bears are set to remain in charge, as rallies in the pound are therefore expected to remain capped. Let us also remember that the market was heavily loaded with put options in sterling before the referendum. Now it is time for execution. Put options trail down from the 140 strike for the month ahead, meaning selling pressure on pound-dollar should remain. Hence, traders could see the rallies as an interesting opportunity to strengthen their short position. On the euro-pound, the 0.80 level shelters call options. Nevertheless, the option sizes are much more reasonable, which fundamentally makes sense, as the Brexit is expected to have a negative impact on the European countries' trade terms also. The rating agency S&P has already revised down the European Union's credit rating from AA+ to AA with a stable outlook. Now let's move on to the other side of the Atlantic, as traders' attentions will shift to the US next week. The FOMC meeting minutes and US jobs data are both on the agenda and should give a fresh direction to the US dollar, which has strengthened well following the Brexit referendum, as investors looking for safety move their cash into the US dollar. Now, of course, the UK's decision to quit the EU and uncertainties surrounding such a historical decision pushed the Fed hawks on the sidelines, with expectations for a Fed rate hike falling sharply. As of today, the market gives a less than 10% probability for a Fed rate hike to happen before the end of this year, and only 1/3 of investors expect the Fed to raise rates before September next year. This means a full-year shift in rate hike expectations, which should sooner rather than later weigh on the US dollar. This is why the FOMC minutes should be analysed keeping in mind that they belong to a pre-Brexit era, and now the balance has shifted. The US jobs data will of course be in focus. Let's remember that last month's non-farm payrolls read was a decent disappointment, with the US economy adding a mere 38,000 jobs in May. Although the Fed Chair Janet Yellen said that a single data point does not mean a lot, a second month of disappointment could accelerate the downside correction in the US dollar. The consensus for June's non-farm payrolls print is 180,000. Finally, gold has been among the biggest beneficiaries following the Brexit decision. The rush to the safe haven assets, combined to a broadly softer monetary policy outlook, is expected to give a sustainable base for a further rise in gold prices. We expect to move to the 1400 mark in the mid-run. That's all for the week ahead. Join us next week. Have a great weekend, but for now, goodbye.